right, well, good afternoon, everyone. Thank you for joining us. I think we'll go ahead and get started. Thank you for joining us today for our Investing 101 webinar. My name is Josh Antis, for those of you who don't already know me, and I'm in the Community Relations Department here at California Coast Credit Union. We love our partnership with the City of San Diego. We love doing these webinars for you, and we're going to continue to do them monthly, so keep an eye out for those emails as they come out month by month. Before we get started today, a couple of things I want to talk about. First, we have everyone placed on mute. So if you have any questions, we do want to answer those for you. You can place those in the question and answer box or in the chat box. We'll be monitoring both of those, and we'll answer your questions either as we go or at the end of the presentation today. We also have a survey. It's just a few questions, like 5 or 6 questions at the end of today's presentation that you will also receive by email. If you could take the time to fill that out, we're going to do a raffle for a $25 DoorDash gift card for everyone who takes the time to complete the survey. So you can win a prize just by giving us your feedback. So we appreciate learning a little bit more about how we can continue to improve as we go. So your feedback is much appreciated. And I do want to mention we have a lot of great resources available to you as City of San Diego employees. I'm going to put a link in the chat right now. This link is a landing page that includes a lot of great information and resources when it comes to finances, and it's all free. We have our Enrich Financial Wellness portal that has videos and tools and articles and games and courses you can take all on everything that's related to finances, budgeting, credit scores, debt management, retirement, investing, anything you can think of. It's all there. It's very robust. You can check that out. We have a financial wellness center that our staff actually is manning live a couple of days a week, a couple hours or 3 hours a day. It's Tuesday, Thursday, 11 to 2 p.m., I believe, is the time on that. And it's completely virtual right now. So on that page, there's a link where you just click either day, whether it's Tuesday or Thursday, and it'll take you into a Zoom room similar to this. And there'll be someone there waiting for you live, and they'll talk to you about anything that's on your mind, financially related anyway. Well, maybe not financially related too. If you want to talk through anything else, maybe they'll listen as well. But they're there to help you with your financial needs. Again, they can help you build a budget, improve your credit score, get out of debt, provide all kinds of tools for you. They can also they have the ability to open accounts, start loans. It's also kind of almost like a virtual branch, if you will. We can do a lot of great things for you there in regards to our products and services too. So stop by there anytime. It's all on that link that I included in the chat box. And lastly, this webinar today will be recorded. So we have a YouTube page built just for you as city employees as well, where we house all of the recordings for all the webinars that we do. So in the next probably a couple days, maybe by Friday, we'll have this posted on that YouTube channel, and you can take a look at it and review anything that you might have missed, or if you want to grab any of the links or anything like that, they'll all be there for you. We always make sure to put the links in the description for everything we talk about, so you can check that out in a couple of days when we have it up. All right, so before we get started, I want to introduce Karen Burke-Acosta. She's with our Business Development Department. Some of you may have seen Karen out and about before COVID hit anyway. She's actually, she wears multiple hats, but business development is one of them. And she'll be on today to answer any questions that you might have in regards to any of our products and services at CalCoast. And our presenter today is Kyle Johnson. He is with CalCoast Financial Services, our financial service wing to CalCoast. And he's a financial advisor that's been with the credit union now for some time. Kyle is a wealth of knowledge. He and I always kind of, especially with investing, I'll pick his brain whenever we talk about this topic, because there's so much to know and to talk about, right, with everything going on. But Kyle's got a great presentation for us today. I'm going to go ahead and turn it over to him, and we'll kick things off.
Awesome. Thanks, Josh. Appreciate it. And yeah, thank you so much for having me and for your time today. I appreciate it, guys. So like Josh said, I'm a financial advisor here. And what I do for members is I help them, invest outside of just kind of our traditional CD lineup. I help them with retirement planning, 401k rollovers, anything that really has to do with kind of wealth management. That's where we step in, right? So we're kind of that division of CalCoast. So the presentation today, It's Investing 101. Now, that being said, I always think it's kind of a funny title because I think if you really understand all of this, you're probably better off than 90% of the people that I usually see. So, and I'm going to try to keep it as brief as I can. So, if you have questions, please feel free to throw them in the chat box. Could be anything. What do I think about the markets today? What do I think about, inflation? We'll go over things like that in a little bit. Um, you know, uh, Anything you guys want answered, I'm happy to help dive a little bit deeper, but I'm going to try to skim over a bit and keep it more surface level for now because there's a lot that you can dig into with these topics, as you'll see. So what we're going to start with is kind of the agenda here, right? So why invest, right? So first and foremost, why invest? Investment basics. So, we'll talk a little bit about mutual funds. I'm going to throw in ETFs. This is a Franklin Templeton presentation, so obviously there's a bend towards in mutual funds, but I'll lump them in the same category. We'll talk a little bit about asset allocation, and then we're going to talk about why to invest now. So why invest? Sorry. So these may look familiar to you. So, there's a lot of reasons why people invest. So maybe you're buying a house, maybe you want to pay for college tuition, maybe you're saving for retirement, maybe you just want to buy a car, whatever it is. Investing is a great way for you to grow your wealth and have your money work for you, right? A lot of people out there have an understanding that saving is the same as investing. Well, I'm going to show you a couple different reasons why it may not be. This is a quick graph of total returns for CDs after taxes and inflation, right? So as you can see, and as you've probably seen out there, CDs really aren't returning a whole lot these days, right? So this is an older presentation. It goes to 2016. I'll try to revamp it to today's numbers, but essentially, CDs and most interest rates and things like lending, everything else drives off of the U.S. Federal Reserve Bank, right? They set the risk-free rate of return, which is their rate. They call it the risk-free rate of return because if you lend them money, $10, let's say, they could always just print $10 and give it back to you, right? So everything from there, if you step up in risk level, right, you usually pay a little bit more money. And so that's where it extrapolates into the broader markets with things like CDs, right? It's things like bonds, things like lending, right? And then, personal loans, things like that, right? So as you can see, the actual rate of return when you factor in inflation with CDs, you're actually losing money, right? So if you're not investing above and beyond just regular CDs or just a money market account, you're technically going to be losing money to inflation. We've actually seen in the news recently, which I'm sure maybe some of you have seen, that there's been a spike in inflation, right? So after COVID, the economy's roaring back. There's been some supply chain issues. And so not only do we have increased demand, but we have supply and logistics kind of trickling in, a little bit less fluidly than it was prior to COVID. Now it's working itself out, but the Fed has said that they're willing to let the interest rates go up to somewhere around 3 to 4% before stomping it out, right? And raising interest rates in order to combat that, right? And so, so if you have your inflation raising at about a 3% rate, and you're making, maybe 1 to 2, maybe 1% on your money, well, you're losing about 2% a year, right? So again, just a little bit on the importance of investing, right? So again, inflation shrinks your buying power. So this is a quick example of it. Let's just take the car, right? So in 1996, a new car was on average about $18,000. In 2016, that was about $26,000. And they're estimating that in 2036, the new price of a car is going to be about $39,000. If you look around, I actually just bought a new car, and looking around, that seems about average. That seems like it's tracking almost correctly, right? So again, if you're just putting your money in a mattress or just kind of leaving it there and not investing, you're not doing yourself a whole lot of favors. Even just not just in a 401k, which is great, or an IRA, which is great for retirement. That's amazing. I think it's really important that you also think about investing and growing the money that you have that is just sitting in a bank account, right? So your savings, things like that. There's obviously, you have to factor in a few things. That's what we talk about. Normally we help members with, but in terms of having enough cash on hand to make sure that you're not investing too much or taking too much risk. But I think it's important that you at least start to grow it. So normally when we talk about investing, we talk about three main asset classes, right? So stocks, bonds, and money market, right? So for some members and some clients that we have, there's certain portfolios that are appropriate to have, alternate types of investments, things like commodities, potentially things like managed futures, maybe annuities, right? And that's really dependent on your goals and on your risk tolerance, but and time horizon. But we're going to talk about the three main ones, right? So let's talk a little bit about stocks, right? So out of all the asset classes, stocks are the gas pedal, right? So these offer the most capital appreciation. So stock, for those of you that don't know, or maybe you're unaware, are new to investing, it's just partial ownership of a company, right? So you buy a share of Amazon, you now own a part of Amazon as a company. So as this company grows, as their revenues increase, as their profit margins widen, you actually own a part of that. And because of that, that little piece of paper that you own and that partial ownership in a company expands, right? And it becomes more valuable, right? The more buildings they buy, the more trucks that they own, you actually own part of that. And so they inherently have a greater value. So, if you look at the stock market on a very long-term basis, it tends to be a straight line, more or less, up with a bunch of, squiggly dots in the middle of it, right? Obviously, there's a lot of things that can happen, a lot of risks that are inherent with stock, investing. However, as long as companies continue to innovate, continue to grow, expand, then the value of those expands as well, right? So as you can see, if you were to invest $10,000 back in 1996, in 2016, you'd have about $43,000 of that $10,000. Bonds, you would have had $10,000, then you'd have 28,000. CDs, 17. T-bills, you would have made about $5,000 on that over a 20-year time horizon. I did a little bit of math. I recalculated it for today's dollars. A stock, if you would have invested in 1996, that $10,000 is now worth $100,000 and $100,067. And then the bonds, you'd have about $33,752, right? So again, growth is a good thing, but also you look at this, you go, okay, well, why don't I just invest everything in stocks, right? If it's making the most money and it's a gas pedal, why wouldn't I just put everything into it, right? So here's kind of the best annualized returns for the stock market versus the bond market. Annualized, stock did 33%, which is great. Bonds, 12%. Still nothing to shake a stick at, but it's but not quite what stocks have returned. An average, you've had, maybe, a couple of percent higher in stocks, which is great. At this point, in today's dollars, it's a little bit bigger of a difference, but still, you'll notice that it's not too big of a difference here, right? Now, you look on the flip side of things, what were the worst years, right? In stock, you had a, 30%, 37% down during 2008, right? You would have lost 37% of your total value of your portfolio. Bonds, you would have only seen a drop of about 2%, right? And so, as you can see, they're very different types of asset classes, and having an asset allocation that suits your risk tolerance is going to be crucial, and your goals is going to be really crucial. We'll talk a little bit about mutual funds again. I'm going to lump in ETFs in here as well. But essentially, we're talking about vehicles that help you diversify within one position, right? So if you buy a mutual fund, A mutual fund is an actively managed investment company, right? So it's actively managed. There's somebody who's either picking your stocks or bonds or even combinations of both, right? So it's a broad basket of either stocks, bonds, or both. Sometimes commodities, things like that. But at the end of the day, it ends up being actively managed, right? So all of them can be different. They're very different asset classes. They're, just buying one mutual fund does not mean that you're buying, one mutual fund could be a stock mutual fund, one could be a bond, T-bill, right? And these are, or a biotech, right? So these are going to perform very differently and have very different risk profiles, right? Essentially, these mutual funds pull money from individuals. There's essentially, they build them for a specific purpose for a specific type of investor, right? Or for a specific part of your portfolio, right? But it's a good way to get diversification just in one in one kind of position. So you could have a broad-based approach to, let's just say, a certain sector like technology or biotech or international bonds, things like that, without having to pick, an individual bond and not the same risk of saying, hey, I'm just going to put everything on black and just buy Apple, right? So again, some of the advantages: diversification. You have some professional management, like I said. So I like to use mutual funds in areas that I don't know very well. And I think that that's a really good, strategy for a lot of people, right? So let's just say if it's, let's just say small cap Brazil. I don't know much about Brazil or China, right? I don't live in China. I don't know a lot about, small companies in China, but there's some people who are professionals at that do. So if I want exposure to that area, I probably would choose that over an ETF. So by the way, an ETF is similar to a mutual fund, except for it's essentially static, right? Where there's nobody picking anything. It's just, here's your basket of stocks. For instance, a popular one is the S&P 500, right? These are the 500 largest companies in the United States by cap weight. So if one company becomes smaller, it gets replaced by another one, and that's your lineup, right? You're going to get the performance of the 500, and that's pretty much it, right? Nobody's picking things. No one's saying this one's better than that one. It's just more of a broad-based index, right? So, but again, it's affordable, right? So it's convenient to buy a bunch of different, positions all at once. It's affordable, and by affordable, I mean, you can buy $1,000 worth of a mutual fund, right? That may include names like Amazon, Alphabet, Microsoft, without having to buy, one share of Amazon, by the way, currently is about $3,500, right? So with $1,000, you can't even buy the one share. But in a mutual fund or an ETF, you can buy a whole basket of them without having to just buy the individual positions, right? And it's liquid, right? So liquidity, what does that mean? Well, within investment accounts, unlike, let's just say, CDs or annuities, things like that, investment accounts tend to be liquid, meaning that you could sell a position and you'll have cash within a couple of days, right? The only time that I've ever seen people, not have the same liquidity that they need during that day, I've never seen it for a health issue, or, if you go to the hospital, you usually have a few days to sell a position and get money in. The only time I've ever seen it is if you need money for a car, you're looking for a Craigslist car and you see one that day and need cash on hand at that time. Other than that, a couple of days usually is liquid enough for most people. So there's a few risks with mutual funds. So there's principal or market risk. So, with investing, the kind of other side of it is that you may have liquidity, but with the liquidity, right, you give up principal protection of principal, right? So you're not guaranteed that your money is going to be the same values when you put it in, no matter what. So there's always going to be certain factors, certain risk factors out there that will have an impact on your value of your portfolio, right? So, you could have let's just say Google, you could have an antitrust situation that comes in, and then all of a sudden, Google goes down, right? So you have things like interest rate risks, right? So I'll go with interest rate risk. This usually pertains to bonds, right? So the reason why it pertains to bonds, interest rate risk, as interest rates go up, bond values tend to go down. Reason why that is if the Fed decides to raise interest, and this is what we've kind of seen recently, if the Fed decides to raise interest rates in the future, then everything else extrapolates from that. So if Coca-Cola had to sell a bond at 5% and the interest rate with the Fed is at 2%, right? And the Fed decides to raise it to 3%, well, now Coca-Cola, because it's a more risky type of lender, they're probably going to have to compensate the investor by now raising their interest rates on their bonds to 7%, we'll call it, right? And so if you're that person who just bought a bond at 5%, and now Coca-Cola, the same company, is issuing the same bond now at 7%, well, if you want to sell it before it matures, well, now you have to sell it at a discount because they're now selling the same bond with the same credit quality at a higher interest rate, right? And so that's where you see an interest rate risk, and that's where you want to be specific with what types of bond funds you own within a rising interest rate environment, right? Which we may see ourselves in a couple of years, right? So I wouldn't say you would need to get out of bonds. You're still going to be making money over the next few years, but there is a risk with that, right? Foreign risk is simply things like currencies, right? You might have a currency risk. You may have things like a credit quality of a country, and then you may have a Kim Jong-un type of situation, right? So black swan events, wars, things like that. And so those are always risks you're going to have to deal with. So there's different types of funds, like I said before, that are specific for different parts of your portfolio. Growth funds tends to be own more growth companies like NVIDIA, Amazon, Microsoft, ServiceNow, things like that. And these are high growth companies, and they're rewarding their investors by continuing to have higher earnings, higher revenue, and expanding from a growth perspective. Value funds tend to be more mature companies, things like Coca-Cola, Procter & Gamble, right? They've kind of hit their market cap a bit. They're not really expanding much, but they tend to have more dividend type of, they reward their investors by having a little bit more dividends, right? And there's sector funds. So again, if you're looking at getting into, let's just say biotech, right? That's a huge one for a lot of people. Small cap, right? That's another sector that you'd have. Healthcare, right? Technology, cloud space, cybersecurity, right? These are all different sectors that you can invest in, and you can have different funds that are specific to those sectors, right? Bond fund investing, there are taxable bond funds, right? So these are normally Coca-Colas, things like that. If you have a higher income, let's just say in retirement, maybe you're making $200,000 a year in retirement, and maybe you're getting close to that next tax bracket if you start making more money. Well, if you have regular bond funds, that is going to look like income, right? And that's going to that might kick you into that next tax bracket, right? Tax-free bond funds, these are usually municipal bond funds. If you live in California, the California state bond funds, and so they get the interest on those could be federally and state tax free. So depending on how much you make, even though a regular bond fund could give you more money, at face value, your tax adjusted rate of return could be better on a tax-free bond fund or a municipal portfolio. If you have questions about that, let me know. Again, so here's the disclaimer: bonds are particularly sensitive to interest rate movements, right? And their prices will fluctuate with market conditions. But if you hold on for the long term, they're a reliable way to make money in your portfolio over time, right? Again, they're more conservative, but they're a good way to make you more money over time. So we're going to talk a little bit about foreign stock, right? So this is just to show you that there's a lot of opportunity, let's just say globally. So the US just isn't the only game in town. I like the US personally for my clients. For the most part, most of the portfolios, I think it's the most reliable game in town. But there are certainly opportunities internationally. Places like India, China, Brazil, I think are great places, and they have a lot of opportunity. So again, the foreign market cap in 2016 was almost the same as the U.S., but the foreign bond market capitalization is much higher than the U.S. Right? These are more dramatic today, but there's a lot of opportunity out there. So again, having a manager who knows different areas internationally is a really big deal, because I certainly, like I said, don't know anything about China small cap, right? So here's kind of an overview of the best performing stock and bond markets between 2006 and 2016. So even though this is an older, deck here, that's a good amount of time there, right? 10 years, and you'll notice that one country isn't on there, it's the US, right? So again, there is some international opportunities out there. Again, asset allocation, definition of asset allocation, we like to diversify. And so a good way of doing that is diversifying your assets, right? So investing your money in different asset categories, typically including stocks, bonds, and cash equivalents. So your investment portfolio is well diversified. Cash is certainly a very valuable part of anybody's portfolio. We typically don't think of cash as an important part of a portfolio, but it very much so is important, because I'll show you a few different decks or a few different slides here. We want to make sure that you're comfortable. If you have enough cash on hand to invest comfortably and leave the money in there and not worry about fluctuations from day to day, you're going to come out on top, especially much higher than people who tend to jump in and out of the markets, right? So here's another slide why you should diversify. So if you just look at, I call it the M&M chart. There's a lot of different names for this, but essentially what this shows you is movement from year to year, right? So we'll take small value stocks, for instance, this orange one, right? So if you pick any one of these and you follow its movement and its annual returns over time, you're going to see it's a pretty wild ride. You're going to see it from here go all the way down to the very bottom, the worst performing asset class. Then it jumps up to the top performing asset class for the next 2 years. You'll see it come down, go up, come down, up, down. You'll get dizzy kind of looking at it. But that is to say that it's important to create a strategy and to stick to that strategy, and maintain your expectations for long-term growth, and invest in the areas that you think that you have conviction in and you believe are going to be doing well over the next few years. Here's a few popular strategies for investing, right? So let's just say you're chasing the winners, right? So for 20 years, since 2016, if you would have invested in the last best performing asset class, let's just say last year small cap did really well, so you're like, okay, well, I'm going to put all my money in small cap. Well, you would have had a average annual total return of 6.92%. Now, if you would have invested with a loser, right? So if you would have just picked the lowest performing asset class, bought that one at the end of the year, you actually would have done better if you would have chased the winners, right? So just because it's a loser doesn't mean, or that it didn't do well last year, doesn't mean it's a bad asset class. It just means that it may not have been correctly priced from a market perspective, right? Now, asset allocation, if you would have just picked all of them broadly and then just invested in them all and just left it, you would have done better than either strategy, right? And so again, consistency and a long-term view is a really big deal when it comes to investing. So this is what we tell clients all the time. History shows that time, not timing, is the key to investment success. So rather than trying to time the market and try to get in at the right time, it's less about timing the market than it is time in the market, is what we say. So if you had here's another example of that, right? So if you had $10,000 and you are a phenomenal investor and you invested every year for the last 20 years, you would have invested $200,000 over that amount of time, right? If you're the best investor in the world and you pick the best day to invest that 10 grand, you would have put in $200,000 and you'd have 528,000 after that. So you would have had a 8.82% return. If you're a terrible investor, you think you're awful at investing, and you're this person, right? If you put $10,000 in every single year and you did it at the absolute peak of the market and the absolute worst time over the last 20 years, you would have put in 200,000. You'd still have almost $400,000. You would have almost doubled your investment, and you'd have a return that's only about 2% worse than the person who invested at the absolute best time, right? So why is that? Well, the reason why that is that if you invested that $10,000, let's just say it goes down to $5,000 because it cut in half because you invested in OA. Well, that $5,000 is still invested, and it just continues to be consistently in the market over the next year, the next year, and it compounds on itself. So that growth has a compound interest aspect to it, and which is essentially the financial equivalent to a snowball rolling downhill. So every rotation you pick up more capital gains, it gets bigger, and then that money makes more money on that, and so those small percentages make a big difference, especially when it comes to investing, right? So again, if you're consistent, it's a really big deal. So if you would have missed, now these are the people who would jump in and out of the market, right? So if you're that person who gets kind of itchy trigger finger and wants to jump in and out, you see the market going down and then you want to bail. Maybe this happened to you in COVID, right? Happened to a lot of people during COVID. And it's it ends up being really detrimental to your portfolio. So if you would have been fully invested, again, that average annual return was 7.68%. Sorry. If you would have missed the 10 best days, only the 10 best days of the year, your annual return would have been cut in half, right? So, which is a big deal. If you would have missed the best 20 days, it would have been cut down to 1.58%. If you would have missed the best 30 days, or best month, you would have been negative, right? And then the best 40 days, you would have been down 2.43% every year. So again, oftentimes the best days tend to come right after the worst days. So you saw during COVID, there was 10% down days, and the next day is 10% up, right? If you would have sold at that 10% down, not reinvested at that 10% or not left it in there, then you would have missed that 10% up on the other side of things, right? And that ends up making a big difference. So dollar cost averaging, it's a big term for really just consistent investing. It's a very simple concept, but it's actually really powerful. So again, you begin investing, you focus on accumulating shares, not on share prices, and then you be prepared to weather market declines. So this is essentially just creating a portfolio, investing consistently over time, and then letting the market do the work for you, right? So let's just say hypothetically in January, you have $500 that you put into your portfolio. This is what you do with a 401k. And I think this is why it's so powerful to have a 401k or to have a retirement plan. They force you to do that, right? And it ends up, and consumers and the average US investor is much better off these days because we've set up requirements for you to invest in your 401k automatically, right? Now, there's no requirement for your savings account money, right? There's no requirement for the money that you have on hand, right? For you to do that. But if you do, you could see the same types of results, and oftentimes probably a little bit better, because it's you can be more precise with what you invest in, and have more control over your investments in a regular investment account. So if there's a $500 monthly investment, let's just say, and the share price is $8.50, well, you would have purchased 58 shares, right? So February rolls around, you put in the same $500. Now that the share price is $10, now you bought 50 shares. Buy the same thing in March, $500. Now the share price is higher, so you buy fewer shares, and it's $43.50. April, $500, $10 a share. Now you're buying 50 shares, right? So overall, your average share price is $40, right? You purchased 200 shares, but because you're buying more shares at a lower price and fewer shares at a higher price, right? Because when you're investing consistently, if the price goes down, you get to buy more shares. When the price goes up, you get to buy fewer shares, right? You end up having a better price per share than the average, right? So you'll notice that the average share cost, the average share price was $10, right? But the average share cost to you was $9.88, because you, again, bought fewer shares at a higher price and more shares at a lower price, right? So even if the market was sideways and just kind of went like this, and you end up in the same place, if you would have had that strategy, volatility ends up being your friend, and you actually would come up on top, and you'd have more money than what you started with, even though the market just went dead sideways from point A to point B. So just something to think about, especially if you're worried about investing and you think it's too risky, things like that. Growth of a hypothetical $10,000 investment, right? So, this is a little bit more of a, hey, if it's not just it's not just investing, it's what you invest in. So if you're a little bit more aggressive and you put in $10,000, or let's just say you're conservative, you put $10,000 in at 3%, you're going to have $18,000, right? If you decide to step up to a moderate portfolio, there's maybe a mix of stock and bonds, right? You put in $10,000, you maybe have a 7% return annually. That $10,000 turns into $38,697. And if you go all stock and you're younger or you're just more aggressive, right? You don't even have to be younger, right? But you just want to have a more all stock portfolio, and you make 11%, then that's $80,000. So that's more than quadruple what you would have had you just invested in just bonds, right? A more conservative portfolio. So there's a risk reward trade-off with investing always. And so the more risk, the more reward, typically, right? But again, you have to make sure that you have a conversation with a professional, or with yourself, but really just have a conversation and just say, okay, well, is this the right fit for me? Is this something I could stand? Do I feel comfortable investing in this for the long term? And if the answer is yes, then I think you're halfway to where you need to be. So I hope that's helpful. So that, I know it was a lot, but any questions, happy to answer them.
All right, well, thank you so much, Kyle. We do actually have a few questions that have come in, and they kind of have a range of topics on them, so it's interesting. But the first question is there a fund?
Is it Bitcoin?
Well, one of them is. I figured
There's
you'd
always
probably
one.
guess that. But the first one is there a fund for electric vehicle market or green energy market?
Yeah, there's a few. There's a few different funds out there. Usually more of renewable energy. That's a big one. Solar is a good one, but there are electric vehicles, ETFs, and mutual funds out there, right? I would say if you're going to be investing in that, I would use that as maybe an alpha within your portfolio, right? And so, a smaller allocation to it, and don't just dump everything into that basket, unless you really want to go big. But for the most part, because it is kind of in its infancy, we don't know which companies are going to be on top, right? So, for a while, BlackBerry was the #1 phone forever, right? And nobody could take that thing off the top. And then now look at what's going on now with smartphones, right? So Apple all of a sudden is this huge player. You would have never seen Samsung coming, right? So you can see some pretty wild price fluctuations in funds like that. But I think it's a great thing to have is as a part of your portfolio if you want to overweight.
All right, great. And by the way, is there another slide that has your contact info after this one?
Oh yeah, there is. Sorry.
There we go. Okay, perfect. Yeah, because we got that question as well. And then here's one of the crypto questions. Can you talk a little bit about a little bit about it and how does it work, and is it an investment you recommend making?
Yeah, so I say this all the time. I think so we'll talk a little bit about what it is, how it works. There's different types of cryptocurrencies. Some are based off of just strictly value. So the adoption of it. So how much people own it is how valuable it is. Other of them are based on things like contract completion, things like that. So they have an actual process that helps facilitate a business need. And the more that those get adopted, then that's where the valuation comes from, right? So something like Bitcoin is really just digital gold, right? So the more that people ascribe a value to it, so they're buying it with other dollars, fiat currency, then that's where the value is derived from. And because it has a very, and Bitcoin itself, for instance, just has a very static, there's only a certain amount out there, right? How it works, very intricate, but essentially there's an algorithm that needs to be solved. So you have a transaction, you have an agreement with someone else that goes to a third party and they solve for the agreement and connects that dot for you. And then that goes through. And so that's where you end up having the transaction goes through, right? So we call that blockchain. That's what the technology is that enables that. But essentially what I'd say is it's very new. There's a lot of things that could go wrong with Bitcoin and with all these different altcoins, things like that. And so it's kind of the Wild West out there. So I would say I wouldn't put in anything more than you're comfortable with losing, because unlike investing in stocks and companies who have an actual value, they have tangible products, they have stuff that you own. For a lot of the altcoins, things like that, they could go to a value of zero, right? An absolute zero, right? So again, I think I own some. I think it's good to be speculative. That's a good spec, but I would say just don't own more than you're willing to lose. That's all.
All right, and this question is kind of related to that. What percentage of crypto should be in your portfolio brokerage account, not retirement account? Is crypto a medium to long-term hold at this point?
Good question. Crypto, it really depends on the person, right? It depends on your conviction in crypto and which coin you're convicted in, right? They're very different. So just saying broadly, crypto, Dogecoin, for instance, was meant to be a meme, right? It's just people just described a value to it, maybe just because it's funny or whatever else. There's a few different technological parts of Dogecoin that make it kind of appealing, but at the end of the day, a lot of it just has to do with short-term investing, and it's more trading at this point, right? A lot of these different coins are more trading, unless you're actively trading and you're willing to look at the moving averages, look at the technicals on it, and then make sells on a regular basis. There's only a few different coins that I think would maybe be like longer term holds, and even then they could go away, right? So again, I would just say if you believe in it, two things: what's your conviction? What are you willing to lose? So if you have a high conviction rate and you're willing to lose some money, then that's the amount of the portfolio, then you should probably hold it, in my opinion. So, but I would look for, if you want to increase that, look for different points of conviction, right? So more adoption of it from corporations. One thing that wasn't very exciting this month was kind of the crypto crackdown with China. There could be things like, let's just say, China is probably going to adopt their own digital currency, right? The US may adopt its own digital currency. They may have issues and take market share away from other coins, right? So there's so many things that could happen, that you may, again, that we may not even foresee at this point, that just step with caution, right? Use your best judgment.
All right, so moving on from crypto. Sorry, I got to echo there for a second. Moving on from crypto, when thinking about how to move some of your funds from savings to investments, would it be better to invest your emergency fund or like a savings fund for a car, for example?
Yeah. So good question. I would say, so the emergency fund, we really want to keep that mostly in cash, right? So generally speaking, we have a rule of thumb, and the emergency fund really depends on you as a person, right? But essentially, it's the amount of cash that you have on hand that you feel comfortable with having, from on a daily basis, right? For married couples, since you have two people with two jobs, usually that what we try to calculate is maybe 3 months of living expenses, right? So because if somebody maybe loses a job, they could have 3 months to get a new one. Meanwhile, the other person is probably still employed, right? One or the other, right? For someone who's single, generally speaking, maybe 4 to 5 months of living expenses, potentially in cash, is a really safe margin. Just gives you time to find a new job, things like that. That being said, like I said, is liquid. So you could sell your investment parts of your investment portfolio to fund, and I've done that myself. I sometimes don't practice what I preach, and so personally, I'm more comfortable with investing. So I don't necessarily have as much in cash on hand. But if you're a more conservative investor at the most conservative type of rate, I would say that might be appropriate. Now, if you're going to be investing for a car, for instance, right? Well, how long until you need that car, right? Or when are you trying to buy it? If it's in the next 6 months, then I don't know how much good, we don't really know what's going to happen. Nobody has a crystal ball, right? So if you're going to invest that money for 6 months, well, it could go up, it could go down, right? If that's your only money that you have to buy that car, you may want to hold that in cash, right? If it's maybe, you're going to need a car in a few years or something like that, then I would say certainly invest that money. But really, I would just say, hey, what kind of cash do you feel comfortable with having on hand? Really dig deep and be like, I feel comfortable with having this amount of cash on hand. Anything outside of that, I would say, then you're talking about, hey, what's my risk tolerance? What do I want to do with this? How, what are my goals over the next few years? And then you just kind of invest according to that. And if you wanted to start, with a little bit, and then you say, well, the next question is, and what's really probably going to help you is, how much am I making above and beyond what I'm putting into my 401k and using for living expenses, right? How much cash can I probably put into an investment account on a regular basis rather than my savings account, and grow that amount over time? If you can calculate that and you set up kind of an automatic transaction, it tends to be that out of sight, out of mind situation rather than the see it and spend it, right? The see and spend, and that tends to end up having the most success for investors over a long period.
All right. In regards to ETFs and index funds, besides the price per share, the management fees, other expenses, asset allocation, regions, et cetera, what other variables should we look for when we're evaluating ETFs and index funds?
Well, I think with the ETFs and index funds, what you should evaluate is, especially if you're looking for specific type of ETFs and index funds, right? Really, a lot of people put a lot of emphasis on cost, right? What is, what are the management fees? What is the cost of the ETF? How many basis points is this one, right? I would look at performance. So really, the two main things that I look at, especially when we're talking about ETFs, mutual funds, I don't care what it is, I want to know which one is performing the best. And it's really a risk adjusted rate of return, right? Not just, hey, which one has the highest return, but which one has the best risk adjusted rate of return, right? So if I have a small cap, ETF, and well, first and foremost, I'll talk a little bit about return, right? So you obviously the idea in this game is to make more money, right? So you're not investing just to invest. This isn't an academic type of issue for most people. It's because you want to make money. That's why we do it. So, so if you're investing and you say, okay, well, this one is 5 basis points less than this one, or this one has 20 basis points more. Well, if I'm making 2% more, I don't care if I'm paying 20%, 20 basis points more. Like I want, if I'm getting a higher return, I'll take that more expensive fund and make more money, right? So if I'm doing better, I don't care about the cost of it because I just want I'm having a higher return. The other thing is the risk adjusted rate of return, right? And so that means if I'm looking at two kind of equal funds, right, or ETFs, right? And from a performance standpoint, they kind of look similar. Maybe one's outperforming the other end. I probably would take the one that has a lower, that's a little bit more stable over time. And sacrifice maybe 0.5% or whatever it is on that, rather than have the one that's just eking it out, but is really moving, really has high volatility, right? So you really want to manage the volatility and look at those factors, and look at historics and just say, okay, well, over that amount of time, what was the standard deviation? How risky was this in order to get to that point, right? The idea is obviously, especially for me, the worst thing that you can do is jump out of the market at the wrong time, right? In investing. And so the more that I can create a portfolio that has a more consistent upward trend and doesn't do too much of this along the way, the more I can keep my clients invested and, and for the most part, keep them from wanting to jump out. And that's going to make them more money over time, right? So as long as we have, a more stable growth path, I think that's a really key part of looking at investments, right? So performance and risk adjusted rate of return. So I look less at and pay less attention to a couple of bips on it from an expense ratio perspective.
All right, we're about 5 minutes out from 1 o'clock, so we'll kind of wrap things up here. But one more question. What is the benefit of investing with CalCoast instead of an independent financial advisor, and what is the cost associated with that?
Sure. Yeah. So we're pretty similar to a lot of different independent financial advisor workshops. So I used to work at Raymond James prior to this. A couple of our advisors worked at Morgan Stanley, whatever else. We're pretty similar. So I think we're set up in a very similar way. We have a lot of different resources available to us. That's a big advantage, is that we do have just a ton of different resources. But aside from that, it's really the people that you're working with, right? What I've really seen with investing and working with these different clients and different advisory firms over time is that it really depends on the relationship that you have with your advisor, and there's a trust factor, right? But all in all, we're going to be relatively on brand from a pricing perspective. We do advisory. I like to do advisory for the most part. That's mainly my business. Some people do, there's some types of products that are kind of commission based that we can't really help that they are. Insurance is going to always be like that. Annuities will always be like that. But from an advisory perspective, we tend to be somewhere between, it's going to be a sliding scale, tend to be somewhere between 1 and 1.5%, usually closer to the lower end of that for most clients, right? But smaller amounts are probably going to be billed at a higher rate. And we have a little spreadsheet for that, and we'll print out if you want it. So.
All right. Well, I know there was a lot of other questions that we didn't get a chance to answer. So we have a ledger that we have access to from this session. So I'll make sure to notate the questions that everyone had, and we'll answer those. I'll send those over to Kyle so he can answer those for you. Maybe you can talk to him, over the phone, or he can shoot an email, that kind of thing. So apologies for not being able to get to it all. It's a lot of information, but I just want to thank Kyle again for presenting today. There's so many aspects to investing, and it's really helpful to have someone like you on our side to help us out. So really appreciate it. And I just want to make a mention of our portal that we have for you one more time. I'm going to put the link in the chat. It's the landing page where you can find all the great financial resources we have to offer for you. And be sure to be on the lookout for the email coming out next month as well for our next session in July. On the 21st, we're going to get together to talk about dealing with debt. So if you're interested, be on the lookout for that email. Should hit your inbox in the next few weeks. So with that, I think we'll go ahead and wrap things up. Thank you again, Kyle, and thank you everyone for joining us. Have a great rest of your week and a great weekend. And by the way, Kyle, congrats on getting married this past weekend.
Thank you. Appreciate it.
Pretty cool. All right. So take care, everyone, and we'll see you next time.
All right, bye, guys.